By the year 2020, the Chinese housing market started to show fissures. By 2021, this crisis reached Europe, and some of biggest European banks, for example Credit Suisse, started witnessing a collapse. By 2023, the situation went out of hand, and some of the regional American banks, for example First Signature Bank and Silicon Valley Bank, completely collapsed. They all had one thing in common, which is that they were all impacted by the debt market. Now, this debt situation is spiraling out of hand. Over the last 1.5 decades, the governments have taken record amount of debt. But this situation cannot continue forever. What comes up has to go down, and the time to repay starts now. Hi everyone, welcome to today's video. So recently you might have heard the news that Fitch, which is a rating agency in the US, it has downgraded the US debt, or in a way the US bond market, and it is creating a ripple effect on the economy. So on this video, I am going to help you understand three central but very important points. One is that what impact will this bond downgrading have on the bond market itself across the globe? Second key point has to do with equity investors, that if you are putting your money in stocks, then are you going to witness seeing crazy amount of returns? That is a very important piece of understanding that you need to develop. Third and finally, what is it that you should be doing as a rational investor? This is going to be a power-packed video. The content of the video is going to be slightly complicated, but I would highly encourage you to absorb this complex commentary. Investing is a very serious game. If you don't have patience to watch these type of complicated videos, understand macroeconomics behind it, understand fundamentals around it, you are going to make a lot of investment mistakes. I have put in at least 40 hours of research in order to make this video, so a simple like from your side will help these type of videos reach out to more people. So kindly do it. I know that you haven't done it. Now press the like button and we will kickstart this video. But before there, let me show you a very important graphic here, because this translates into the stock market impact. So let me show you two phases. The first phase starts from the year roughly 1990 and it lasts till the time the dot-com bubble happened. So the dot-com bubble burst somewhere around 2000. But if you notice that in this 10-12 year period, the bull run that happened was roughly around 582%. So this was like a very good period for the stock market, so to say. Now let me show you second phase and then I will tell you something really important. So this second phase lasted from the year 2009 all the way till 2020 when COVID crash happened. And during this phase, again, the bull run was very strong, 400% return. So everyone in the last 3 decades has started to assume that, you know what, if I just put my money in equities or stock market and just stay put and become a long-term investor, automatically paisa chhap jayega, I will be able to grow money and I will become like crazy rich. But see, here is an important economic point that you need to understand. Now ask yourself a simple question that, hey, you are looking at this particular phase, why did the market give 600% return in this entire phase? The answer could be that this was a phase when technology was adopted at a massive scale and pace. For example, companies like Google, Amazon, Meta, all these companies came into existence, hardware, software, penetration of internet. Before pre-1990, how much was the penetration of internet? What was the usage of mobile phone pre-1990? Nothing. Now what is the usage of mobile phone? So the last 20-30 years have been major periods of productivity innovation, and most of this productivity add came in this phase. I hope that all of you will agree to this. Then comes a very interesting question ki bhai, is phase mein what happened? That what happened in this phase that the market gave 400%? What innovation happened? You guys tell me in the comment box. I think the innovation that actually happened was called as quantitative easing, or the adoption of quantitative easing. Because after the 2008 crash, there was a lot of pressure on the governments to accelerate growth. They wanted to avoid a 1930-like depression. So what they did was that they started printing a lot of fake money. Now, why am I calling fake money and what exactly is fake money? Well, a simplified version of that would be that, think about it this way, that if the government has to print $10 trillion today, or if the Indian government has to print 1000 crore rupee literally tomorrow, can they do it? Yes. Do they need to ask you? No. How much of it can they print? They can print as much as they like, because pre-1971 money, or the government printing of money, was backed by gold, right? On and off, it was backed by gold. But after 1971, there was no backing to the money that could be printed in the economy. That the major lever for growth has come due to excessive quantitative easing, or money printing, so to say, in the economy. And this was done via the debt market. Now there are two types of markets in the world. One is called as debt market market, which is twice the size of equity market. So when you go on Zerodha, buy like stocks, you are buying stocks or equities. There is another type of market called as bond market, which is much bigger, and all this quantitative easing वगैरह का game starts where? It starts from the debt market. Unfortunately now, Fitch, which is a rating agency in the US, it has downgraded the US debt market, so to say. They are saying that, you know what, गड़बड़ हो रही है in the debt market because you guys have printed a lot of money. You guys have been very callous in the way you have managed the economy, and going forward you are also going to print like even more money, right? So as a result, what will happen is, and let me show you the interest rate chart. So this is the US interest rate currently, which is at 6%. Now before 2008, or rather in this bull run period where the markets gave how much return? Almost like 400% return. Between this zone, the markets gave 400% return. Why? Because we used to exist at 0% interest rate. Now Fitch predicts that, hey, this 6% rate is only going to go to a baseline of 3%. We are not going to go to that 0% interest rate. So as a result, to cut the long story short, and I gave you a lot of backing on economic facts, that going forward, this secular bull run that used to happen, that you are just putting money year after year and making crazy amount of money, that game is not going to play out. You need to understand the complicated story that I am going to communicate now. Now also a very big shout out to our sponsors for today, which is Vested. It is an excellent US stock investing platform. I would highly encourage all of you to become diversified investors. I myself am a diversified investor, and one way of dealing with all the volatility in the world as the world gets de-dollarized is to diversify. So if you're looking to make investments in US stock market, Vested is a wonderful platform. If you use the links in the description and comment box, you can avail a very special discount. So let me kickstart the story, and literally 3 specific points I will talk about. Let us first and foremost talk about part 1, which is that with this downgrade, what is going to exactly happen in the bond market, and is that something that you should worry about? So first point that you need to understand is that there are 4 or 5 major rating agencies in the US, and these are the ratings that they have issued. So back in 2011, S&P downgraded US's rating from AAA, which is the highest rating, to AA+. Now recently, Fitch has also downgraded from AAA to AA+, right? So basically out of 4, 2 have downgraded US's rating. Now you will ask that, okay, isse ho kya raha hai? Would I get impacted on this? So the short answer is yes, that you will get impacted, but you will get impacted more in case you are a bond investor, and most of us are not bond investors in the US bonds, right? So from that perspective, we might not have a direct impact, but there is going to be a very important indirect change that will impact all of us. And what would that be? So again, let us go back to that interest rate thing that I was explaining you, that right now the interest rates in the US are at 6%. The expectation was that, you know what, that these interest rates will be cut and it will be brought down to absolute zero, the way it used to be, right? So you can see, again, check this phase, the interest rates were close to zero. What is the meaning of 0% interest rate? It means that technically the US government can print as much money as it wants, and it would have to pay 0% interest on it from a real term perspective. Now this is a very interesting theory, probably a separate video, but यहाँ से आप देख सकते हो, right? You can see it from here, that the interest rate used to exist at 0%. Even if you don't want to buy this argument of 0% interest rate, just assume that this 2008 all the way till 2020 period was a very low interest rate period in the world. Now what is going to happen is, theoretically speaking, that we will move to 3% interest rate. Now, what is the difference between 0% and 3% interest rate? Well, it is very important difference. ये आप macroeconomic सोच के सुनते नहीं हो फिर चीजें, but fundamentally it is going to be a game changer. So in very simple words, the cost of borrowing in the bond markets from a long-term perspective is going to go up. For example, over the next, let's say 1.5 decades, we might be in and around this 3% mark, not at 0% mark. And this is a major change that the world economy is going to think. Now, let me help you understand the gravity of this situation, that 3% हो गया, 0% हो गया, इससे फर्क क्या पड़ रहा है, right? Well, it creates a lot of impact. Exactly how? For that, understand this flowchart. Now, here is an oversimplified version that, see, if the government gets to borrow at 0%, what they can typically do is that they can run something called as fiscal deficit. Now, the meaning of fiscal deficit is the expenses minus revenues. So imagine this, that your salary is, let's say, 1 lakh, but your kharcha is 1.5 lakhs. So what is the budget deficit that you're running? You're running roughly negative 50,000 a month. So government also does something similar. Let's see, if they can borrow at very low cost, 0%, 1%, so they will go and borrow like crazy. They are going to spend a lot of money. So they are going to expense it out quite a bit. And as a result, they will be able to accelerate the growth. Because why will the growth get accelerated? Because more money or credit is being pumped through the economy. The more spending that happens. आपको क्यों लगता है कि you know what, the credit card economy is growing. One American has four credit cards. इंडिया में BNPL, PNPL, DNPL and पता नहीं कितने PNPL हो गए हैं. So all that thing is picking up. Why? Because government pushes really hard to push credit or money flow through the economy. Now, why is government so interested in pushing this credit or money flow? Because more money you spend, the more money the government spends, it all adds to the GDP number. And what does government really care about? भैया, India $5 trillion economy जाएगा, $47 trillion economy, $99 trillion economy. What does that mean? In simple terms, it means that they are all trying to propel the growth. So this game was going wonderfully well for the governments all the way from 2008 to 2020. But unfortunately, in 2020, there was an unforeseen event called as COVID. Even the governments did not expect this, and even we did not expect this. And suddenly the world needed the governments to actually go and spend money on things that were critical. So government's fiscal deficit पूरी तरीके से हिल गए. So think about it this way, that hypothetically speaking, and I'm just plugging this number here, that imagine that governments all across the globe have taken like $50 trillion in terms of loans. Now this loan will be paid over the next several decades. Now how exactly will the governments pay the loan? Well, by doing two things. One thing is that they are going to increase their revenues. What does this mean in simple terms? It means that your tax is going to go up. And second thing is that they might have to cut their expenses. Not because they want to, but because of the fact that this borrowing rate will go from 0 to 3%. So they can't spend that recklessly the way that they used to in the past. So as a result, because the government will now have to pay 3% interest rate from a long-term perspective, what do you think is going to happen in the bond market? Will the government borrow at the same crazy rate as it used to? My bet would be a no. And as a result, the rate of spending by the government needs to come down, and that will create a slack in the economy from a long-term perspective. You would have often seen me speak about the fact that, you know what, economy is like bad, but stock market is going up. So how are these two things possible? So I just presented that complete explanation. Now this brings us to point number 2, that what is going to be the impact on the stock market. So for this, let's move to the year 2011. More precisely, let's move to 5th August 2011. That was a very important date because that was the day when S&P released the report that, you know what, we are going to downgrade the US bond market. So they degraded the US's rating from AAA to AA+. So you can clearly see here that this was the 5th August and the stock market corrected by roughly 11%. Now, why have I marked this region out? Because ऐसा नहीं होता कि बड़े investors get to know कि US bond rating होने वाली है, this that they get to know all this stuff not on the day when the news is released, but little bit earlier. So if you assume that, then the total fall in the stock market could be attributed to roughly 22%. But what happened within the next few months? So this is like a 6-month window, and here the stock market then rose by 32%. Now, is something similar going to happen right now, that when a downgrade has come from Fitch? The short answer is unlikely, that is not likely to happen. Why is that? Because people already understand this history. Any smart investor studies history, associate what is going to happen. So people are prepared for such a scenario. So no, the stock market in the short term is not going to display this exact history. Now, why is that? Is there some more fundamental reason? We can just simply backtest this technically, that because this has happened in the past, so investors are better prepared and therefore nothing of this sort will happen? No. So there is a fundamental explanation. Let me explain. So if you think from a short-term perspective, now short-term, there is no standard definition of short-term, but anything less than 2 years is considered to be short-term. Now, if you think from a short-term perspective, in a growth economy, there is a very clear inverse relationship between bond and equity investing. Now think about it this way, that from October 21 all the way till entire 2022, the FDs started getting better returns and people started making memes. You know what? सबसे अच्छा investment तो FD है. Why even go to stock market? This that. Well, it's a very basic 101 relationship between bond and equity market. That in a growing economy, and economies were growing. It's not as if that recession हो गया खत्म economy. No, the economies were growing, and during that time when the bond market or FD market was growing, what was happening to equities? The equities were shrinking. So the price of equities was going down and the price of bonds were rising. Now what has happened is, and as per Fitch, what is going to happen next is the fact that bond prices are going to go down. So what is likely to happen to equity prices? Well, the equity prices, because of this inverse relationship, is likely to go up in the short term. This in an MBA school takes like 4 or 5 classes to teach. I am teaching it to you in a very simplified format. हो सकता है आपको थोड़ा सा tough लगे because the concept itself is convoluted, but I hope you understood this relationship, where it is applicable and how it is likely to perform in the future. Now comes the second very interesting point, which has to do with long term. Now, what is the meaning of long term? Now, long term typically means more than 5 years. And this concept has to do with corporate finance. Now, to cut the long story short, if you think that whether it's the government or whether it's the organizations, they have two options for raising money. One is called as going to the equity market, and the second is called as going to the bond market, right? For example, government holds a lot of equity in a lot of companies, right? For example, there are like Maharatna, Navratna companies, all that stuff. Government owns equity. And if the government wants, it can sell that equity and make some money, right? So that's one way of equity financing. That aap apni equity beech do and you get some money in return. Second is that you go to the bond market. You're not selling your company, but you're asking the public that, okay, you guys pay us like 100 crores, and after like 5 years when the bond matures, we are going to pay you a certain rate of interest, 7-8% CAGR के हिसाब से we will pay you, right? So this is called as bond market. Here the company or the government is not losing equity. Now see, if the bond financing becomes more expensive because we are moving from what, 0% to 3%, then what is going to happen in the economy? So as I told you in the previous section that, hey, less money is going to be spent by the government, not because it does not want to spend money, but because of the fact they will struggle to pay this 3% interest without distorting the macroeconomics of a country. So from that perspective, there will be less credit flow through the bond market, right? So this is a very, very critical, important point. So your equity market becomes extremely valuable from that perspective. So to cut the long story short, are equity investors good or bad in a bad bond market? See, if it's a horrible bond market, then it's a different thing. From a long-term perspective, the equity market is going to do well, but it will involve a lot of volatility. Now, what is the meaning of volatility? Let me quickly tell you that, because this is the most important point in this video that will help you make stock market decisions. So here is a chart for the Indian market, and this is the year 2012, right? And this was a bull run period from 2012 all the way till 2016. So this was a bull run period. The market generally was going up, but notice the times the market went down by 10-11%. So 1, 2, 3. If you aggregate this 4, so at least 4 or 5 times the market in this bull run corrected by more than 10%. So this is the meaning of volatility. Right now we are in the year 2023. The markets are going to go up, no doubt about that. It will go up, but it will not go up like this. What is more likely to happen is that in this journey of, let's say, almost 100% gains, right, that the market doubles from this point, there will be at least 15 periods where the markets are going to correct by like 10%. I'm just putting that random figure. Please don't quote me कि आपने exact 15 बोला था, 15 times नहीं हुआ. I'm just telling you, relating macroeconomics to investing. This is called as macro style of investing. I teach this on my stock market course also. In case you are interested, I'm doing a live class on this particular Sunday. You guys can join in. I will also be doing an investment meet in Goa. It will only be reserved for my students. So in case you are interested, do check the details in the description and comment box. So anyways, I hope you got the perspective that the stock market is going to be extremely volatile. Why? Because the bond financing route is going to slow down. Then why will the stock market be volatile? Okay, think about it this way, that a few months back, Adani were coming up with what? FPO, follow on public offer. It means what? It means that a listed company, let's assume that it has 100 shares in the stock market. The company says that we are going to sell out of these 120 shares to public now. Now, what is this doing for the company? Well, the company in simple words is doing equity financing. Now, if company is selling its equity, the company itself is selling its equity, what would it want to do? It would want to sell that equity at very high prices. So there will be situation like IPOs. आपने देखा होगा कि जब Zomato का IPO आया था, it opened up like 40, 45, 50. It gave a massive run up. Then it crashed by 50%. That is called as volatility with equity market. Now, if the entire market starts exhibiting not that level of volatility, but इसका 15-20% मान लो, if that level of volatility also comes into the market, it will cause a lot of heartache and panic. Whatever I am telling you, there is a very, very high probability of that happening. Of course, it's not guaranteed. Any investor can be wrong. I'm honestly teaching you the fundamentals behind it. And in this final section, I will just wrap up by giving you 3-4 investment oriented points. So the first critical recommendation that I will have for you, and again, I myself am doing it, that please buy real assets, whatever you think is real. For example, for me, it's real estate, Bitcoin. I am a believer in that. I invest a part of my money into that. Over time, I am going to divert a chunk of my equity portfolio into these. Why? Because I'm keeping that 5-10 year viewpoint that I told you about. Debt market is getting weaker. The world is getting de-dollarized. As that happens more and more, the real assets are going to become much more valuable. This is the first critical point. Number 2 point is that prepare for volatility. You will not have fun watching your portfolio correct by 10, 15% all of a sudden for no reason, so to say, and you might panic and sell and might not enter. Please don't do that. Learn how to hedge your portfolio. Learn how to balance your portfolio, aggressive, defensive. All these things need to be kept in mind. Please learn profit booking. You cannot just simply buy long-term investor and so जाएंगे invest करके. No, it's not going to work out. 2008 to 2020 rally was a QE based rally, very easy to make money in the stock market. So therefore, the third point is that you must intelligently time the market. Now you'll say Warren Buffett says, you should never time the market. He himself does it, right? I have talked about it on my separate videos, that why is it that Mr. Warren Buffett was sitting on so much cash in the year 2021. Now he has cut down his cash because he was also trying to intelligently time the market. He might have said that statement in some context. लोगों ने वैसे उसमें कहानियां बना दी, right? They have created like quote कि कभी time ही नहीं करना चाहिए. No, that does not mean that you become brainless and stop thinking about the market. कैसा भी market होगा, हम तो invest करेंगे. No, please don't do that type of stuff. Learn to intelligently time the market. Then comes the fourth point, that please book real profits. Real profit means that, for example, if you have a portfolio and if you are seeing it in notional profit, कि अभी तो मेरा 15% का profit चल रहा है, that is notional profit. Learn profit booking. Those are basic things that you must understand. Here is a video that you can go and watch on profit booking. I have taught about the fact when you should be selling your stocks. If you watch this video, you will get that understanding. I hope you enjoyed this complicated conversation, and congratulations if you have fully watched this video. It means that you are a very serious learner about the stock market. 80-90% people would have dropped off, but if you're in that 10% people who continue to watch this complex video, it shows that you're dedicated. Continue to learn. Best of luck, and I am very hopeful that you'll make good money in the stock market. Thank you so much for watching, and I'll see you soon.